Welcome to our Quibico YouTube channel. Before we get started, I'd like you to click on the subscribe button at the bottom to send us an email to inform us that you've subscribed, and we'll send you a free copy of Tax Intelligence by Dr. Daniel Erasmus. This is a book that gets used extensively in transfer pricing disputes. Just click on the subscribe button at the bottom of this video and then click on the bell next to that, and we'll notify you as soon as we upload videos to this channel. Welcome to today's podcast. Today we're going to be talking to transfer pricing expert and postgraduate diploma in transfer pricing lecturer, Mr. Okkie Kellerman. Okkie, welcome. Thank you very much for taking time out of your very busy schedule to answer some of these questions with us today. Ladies and gents, the questions are dealing with arm's length principle in transfer pricing, have been sent to us by some of our students in the Postgraduate Diploma in Transfer Pricing, and we really felt that they would be valuable to you, our Tax Tribe members. So without much further ado, I'm actually going to jump straight into the questions. Is it true that the application of arm's length principle is only possible where there are comparables under similar market conditions? Hence, the transactional profit split is not really an arm's length method, but a variant of global formulary allocation.
Very, very difficult because, let's take, for instance, African comparables or even maybe South American target companies, So if your tested party is going to be in South America or even in Africa or maybe even in some of the Asian countries, you're going to battle to find companies of that region within your comparable. So I think, like for instance, if we look at Africa, we tend to look at Asia and South America, Asian or South American companies that we can find, or maybe some of the Eastern European countries that also have developing economies, so that at least that market conditions are more or less similar. But I don't think we can only apply the arm's length principle on the basis that the market conditions has to be very similar. I think that's why you need to make some country adjustments. So for instance, if you test a loan like in Africa, you will mostly get European or dollar-based information, and therefore the interest rates will be between a UK company and a German company, and the loan will look very different between a Mauritian company and a Ghanaian company. So therefore, one needs to make some country adjustments, and it is a challenge. But bond rates by governments can be used, and I believe that differential between bond rates on, let's say, dollar bonds issued by the UK or by the US, or euro bonds issued by Germany, or British bonds issued by the UK, compare that to what, let's say, a dollar bond issued by South Africa. That rate should in some way show you the country risk, because I'm willing to invest in a US dollar bond for 3% return, but if I have a South African dollar, I may want 13%. So then one can say that some country adjustments could be like around about 10%, but it's very difficult. Unfortunately, transfer pricing is not an exact science, but the only benefit is that it's the same for revenue. So I think that's why the OECD has been on a mission on Pillar 1 to try and supplement the arm's length principle. But I do believe that the pure application of the transfer pricing mechanism of the arm's length price is the only way to go. That's all we really have. I think what's important is that the delineation of the transactions is key in the first place, and then your selection of your method. Once you've got those two right, the right method, and you're testing for the right transaction, you're not testing for a let's say a agency if it's actually a distributor. So once you've identified the right transaction and you've identified the right method, the financial result is part of that, of that result. And I don't think, also I think that's why transfer pricing results are within ranges and not exact numbers. So if you're in that range, then you should be fine per the OECD. Some countries may say you have to use the median, but the OECD only says you have to be within your range. So the transactional profit split is not really an arm's length method, but is a variant of the global formula allocation. So I don't necessarily agree with you on that. I believe that the profit split method is the only transfer pricing method, because it takes your group's complete profit and allocate it to the value contributed. So in essence, a transactional profit split does a benchmarking for, let's say, the manufacturer and a benchmarking for the distributor. So that's the base earnings, and then it just shares the, then it identifies the excess profits. And then you need to find a way to go and allocate that. Now, I think within the new world where we have a RACI kind of, responsibility, accountability, consulting or information, your RACI kind of formula, and DEMPI, the DEMPI kind of ratios that you use under intellectual property, it makes it easier to allocate than the excess profit. And I honestly believe we need a very similar DEMPI kind of acronym for every class of assets, so that it helps us allocating. I think my frustration with the OECD, especially on Pillar 1, is that they are trying to formalize the sharing of the entrepreneurial profit, which is nothing other than a profit split. Because if you look at Pillar 1, in essence, it subscribes to a profit split. But they're saying you need to put more of the entrepreneurial profit now with the let's say the market countries. I'm saying maybe they should give us more guidance on a proper allocation of that excess profit and forget about entrepreneurial market. Just do a pure profit split, because I firmly believe that that's the only method that's really going to survive the test of time. But only time will tell, unfortunately.
Are there guidelines or examples on the kind of adjustments entities can make to get it comparable?
Unfortunately not. So I think one needs to understand and try to get a feel for what the circumstances, market conditions and economies are for the various companies. And also the mix. I think the mix of your comparables will also impact on your final result, because it would be very strange if you do a benchmark comparable and you only get Europe, let's say UK companies or German companies. You should get UK, maybe some German, maybe some Spain, Italy, maybe some Eastern European company. So you may have a spread of that market conditions in any case in that. And I think it's important to understand that mix. So there's no specific recipe of how to adjust. You can understand that some countries, so if I do a higher rate because I think there's a country risk on South Africa, you can imagine that the revenue authority in South Africa will fight that and say, hang on, if it says LIBOR plus 3, why are you adding another 3% because you think we are risky? It would be interesting to see how country risk profiles changes in a period after COVID, where it seems like maybe some of the more developed countries are, up to now has been harder hit than the less developed countries, and what the impacts will be on their economies and how quickly they will, recover. I am concerned, and we'll get to it later, is that the financial data for a year like 2019, 2020, 2021, 2022 may look like a steep curve instead of anything consistent. But no, there are no real leads to, or let's say examples or set guidelines that you can follow to adjust the price. I hope that answers the question.
What happens when there are no proper comparables in the industry code where the target fits? For instance, all the potential comparables have high investment in intangibles and your target is a distributor.
Then I think you've got the wrong method. So then in that scenario, if you don't have any comparables, you need to say, okay, should I then, you either have the wrong method or you should select another tested party. Because then you're not going to get anywhere with the comparables. And remember, the comparable is part of the cup kind of scenario. So then you need to say, can I possibly use a resale minus or a cost plus? If not, can I use the profit split? And in absence of that, I would say you need to go back and see whether what if I take the other party to the transaction as my tested party? But yeah, that is a bit of a problem.
And then we go further. Applying arm's length principle requires comparison of the terms and conditions of the controlled transactions with that of the uncontrolled transaction. That is often not possible with a TNMM because of the lack of detailed information about transactions from commercial databases. Is it therefore true that because of the low level of detailed data and low level of comparability required for TNMM, this method is not capable of producing a fair arm's length price that replicates the dynamics of market conditions? It is only a compromise in place of an arm's length price.
It could be so. So I think that's why, again, I'm saying we're using a range and not an exact percentage. So I think one needs to have like a kind of a subjective test to say, okay, this is my range. What is the impact of this range on both sides of the transaction? I think it's dangerous only to look at the tested party and say, okay, it makes cost plus 5% and then leave it at that. One needs to look at what that cost plus 5 expense, which is now paid to the tested party by someone, what is the implication of that on its financials? You still, if that drops the service recipient into a loss, then we're charging too much. If the recipient is still making out of extraordinary profits, then we need to say that maybe we need to move to the higher end of the ratio of the range. So I think one always needs to do a subjective test once you've got your range to see what is the impact of that range on all the parties concerned in the transaction chain. So yes, I think the net margin method is a bit of a compromise to get to an arm's length price, and again, that's why I think I prefer the profit split, because you can then on the profit split do a net margin for the two, or let's say that in my example, the manufacturer and the distributor. So then you do a net margin more or less for them. You determine what the excess profit is, and then you allocate the excess profit based on the role and the value that everyone contributes. So I think if you use the net margin, in hand with another method, like the profit split method, you may get a better result than purely picking the distributor as the tested party, testing as net margin, and then saying, now Bob's your uncle. I think that's a dangerous approach.
Okay, thanks for those, Okkie. Then going on to the next question, what is the weakest point of arm's length that frequently leads to disputes?
I think it's indeed this challenge on comparables. So if revenue, so that's normally the easiest way is to go attack your comparable. Again, if you look at the OECD on on their approach, it still seems to say that once you've got your method and your transaction right, the result of your comparables is more or less a given. But I think you're right. The weaker your comparable set of data, the more easier it is attacked for revenue. The only benefit is, the revenues don't really have another set of data that I can use that will give him better comparables. So then one needs to find some way of a solution to say, okay, my comparables are weak. I will take the highest point within the range, and therefore to err on the conservative side, I will rather take the highest or the lowest point, depending on what side of the transaction you test.
It is said that once comparable entities have been identified, one must look at company activity, business description, ownership holding patterns, year of available financials, and the financials themselves. Is this only done to refine and make adjustments, or is this a further level of comparability testing?
The only reason for that is that those are the requirements, or the comparable, let's say standard comparable issues that we check to make sure to say if those 5 things are more or less in line, we should have a good comparable. One needs to look at, obviously the company activity is one of the most important ones, and one would like to identify comparables where the activities are as close as possible to yours. If you provide a service, and someone else provides A, B, C, D, and E services, it may not be comparable. The mere fact that they provide that, it may be their smallest business while that's your biggest business. So one would ideally, if you provide, let's say, accounting services, one would like to identify companies that only provide accounting services. If you find companies that have accounting, legal, and auditing services, then the comparables, becomes a little difficult, unless you can understand that accounting is their main business and the other 2 are just peripheral businesses that they will do if required. So that's the activities. The same with the business description. I think one needs to, when you look at websites and stuff, because that's the only information you really have, is to see whether everyone speaks about the same business. If someone says he's an agent, and someone says they're a distributor, then that in itself must tell you that there may be a difference in what they're doing. Their financials might look exactly the same, so the agent will disclose sales. If you look at a commissionaire, if you look at a low-level distributor, he may not take ownership of the goods, but he may also put sales in his business. So I think distributors are good examples, because you can have a no to low risk distributor and a high risk distributor. They look like distributors, they smell like distributors, they report like distributors, but their risk profile is completely different. So one needs to, when you pick up stuff like I'm an agent to operate as an agent, then it's not necessarily someone that's a distributor if you are testing a distributor, and vice versa. Also, ownership patterns, it's very difficult sometimes to use or to get proper comparables that's completely independent, because that would be the best comparable where there's no group scenario. It's a family business or a standalone business, but that's not always possible. So and one sometimes need to dig a little bit deeper into the shareholding, because you don't want to look at a business where the shares are held by Gil, but then in the final analysis is just an agent for some multinational company. Then it's actually a group company. So one needs to look at shareholding, and why is a law firm holding shares in an operating company? Maybe they are just an agent, or for an undisclosed principal. So one needs to look at those shareholdings, because again, that will play a major impact on your comparable. If you use another group company, let's say a company within another group to compare to your company within your group, you may get results that's not arm's length, because that group may not, that their pricing policy may be wrong, and then if you use those results on your comparable, or on your case, then your comparable is going to lead you down the wrong way. So one needs to look at the shareholding and make sure that you have independent, standalone businesses as far as possible. Also, the year of financial, available, it may not have been as important. So if you look at around 2006, 7, 2008, when we had the financial crisis, we saw that in the financials. They looked very weird, So if you look at 06, and then suddenly you thought, okay, now the world has ended. And then 2008 and 9, there was different results. I am concerned that with COVID, our results for the next few years may be ridiculous. But I think the benefit is that at least this happens now across the world, and it's not impacting only 1 or 2 or 3 countries. So you need to look at the financials and try to work with, if you do a 2007, or let's say if you do a 2020 policy, we cannot work. Let me rephrase it. If we're going to do a 2021 policy, we cannot work necessarily with a 2015, 16, and 17 financials. It will just give us a totally skewed result of the reality of the company operating in its 2021 tax year. So you need to look at as close as possible to your financial year comparables. And then you need to look at the financials. Now I know some people may be lawyers, some people may be economists, some people might just hate looking at financials. But you need to understand and get someone to look at the financials to say, hang on, this is actually an agent accounting for his business as if he's a distributor, so that you can understand that difference. Also, you may be looking, you may have differences in GAAP, which is the accounting standards. If you look at the US, they may not even follow GAAP, they will follow IFRS. You may have countries like France who has their own GAAP rules. So you need to make sure that your financials are prepared on the same basis also. And therefore, you'll only pick that up if you look at the financials, go into the notes and try to understand what they mean. I hope that gave some background to the comparables that, to the requirements or the benchmarks we use to try and scrub my comparable group to as close as possible as to what I am.
There are a lot of companies from the database that don't have websites or any other publicly available information required to perform a manual or subjective review, for instance, companies from some Asian countries. Is it risky to eliminate those kinds of companies in the analysis so as to improve comparability, especially where they distort the statistical range?
Yeah, if I cannot confirm those 5 things that I listed up before, then I would rather exclude them than include them. You can be naughty to see what the result is, including or excluding them, and decide, whether you want them in or not. But my concern is that obviously that decision of yours will be based on the benefit for your client and to the detriment of revenue. So those will be the one that revenue will come and attack immediately, saying, how can you include this company? No one knows anything. So I don't think it's risky to exclude them. I think it's risky to include them because, unless you found an article or whatever, you have inside information or people at the company that confirms why, whatever let's say the nature of the business, why you want to include it. Otherwise, I'd rather exclude it.
What would be the main changes in transfer pricing policies that companies will have to apply due to the COVID-19 situation? Okkie, for example, do we need to update current benchmarks and include comparables with negative margins even for low-risk distributors? Or shall we, for example, use the range 2008 to 2010, which would more closely reflect a time of crisis?
Hopefully we will get some guidance from the OECD on this, because but in the end, one needs to understand that the current years, maybe we've got nothing to benchmark, let's say, the 2021 financial year with, because we never had this. Not even the financial crisis can come close to this. So what would be interesting is to see where the OECD goes, seeing that they were beating this drum of Pillar 1 to say share the entrepreneurial risk. Surely they must now agree that we must also share the entrepreneurial losses, because of where business is going. And And do we now, if we now make a loss, how do we recover our losses across the group? So that's going to be a challenge. I also think the diverse effect of the economic crisis will make it very difficult to find comparables. Italy maybe hit worse than any place in the world. Let's take Ghana. Ghana is an African country with a developing economy. Italy is a developed economy. But for a few years, the results may not look like that, purely because of the impact of COVID. So one needs to say, okay, what is the trends within the economy of Ghana versus the trend within the economy of Italy? And you can't use the Italian comparable because it's just not gonna equate what's happening in Ghana. So we will have to look at our comparables, and when you look at a comparable, say, hang on, this one was located in Spain, this one in Italy, this one in Portugal, and which of these, the impact of Corona and COVID, what was the impact on the larger economy in these three countries compared to what has happened in my country, so or my tested company. So we'll have to look at those. Obviously, multinationals will have to look at their inter-financing arrangements. Some subsidiaries, may now need more loan funding, but they will not be making profits. So to charge them interest is ridiculous. The question is, where are the banks going to go? If the banks are going to go to lower interest rate to allow companies to recover, then surely that's a comparable reaction that shareholders need to have on their loan accounts. So you also have to look at the liquidity and make sure that where in countries, and again, it may be in the past, your lesser profitable companies, they may be now your more profitable companies, although it's just marginal profitable, but the others are making losses. So you need to, make sure that your liquidity is spread across the group. And I think then the big issue is restructuring. I think you may see a lot of multinational groups restructuring their operations, cost saving, market centralization, not have a company in every African country, but only have one and distribute them into the region. And obviously we know that, with restructures, and look at the OECD guidelines that we follow the money.
Okay, that then brings us to the end of this Q&A session dealing with the arm's length principle. Okkie, thank you very much for the time taken out of your day. We really appreciate it, and I think that has answered a lot of questions for people dealing with arm's length principle. Ladies and gents, we also just want to point out that following this, there will also be a Q&A podcast with Okkie dealing with functional analysis. You will be able to pick that up in our podcast section on the websites. I also just wanted to point out that the subject matter arm's length principle is dealt with in detail in our postgraduate diploma in transfer pricing, as well as our transfer pricing masterclass that we do offer. Both these are available through either the IITF website or quibico.com, but I will be posting the details for that at the end of this session. Once again, thank you for joining us, and we will see you at the next podcast.
Before you leave, I'd like to thank you for joining us in this video, and I'd like to remind you to subscribe to our channel. Once you've subscribed, send us an email to info@quibico.com to inform us that you've subscribed, and we'll send you a free copy of Tax Intelligence by Dr. Daniel Erasmus.